Accounting for banks. I hope you already have the notes. Let me assume so. What are the major sources of income for the banks? No. Customer deposit actually to a bank, it's a liability. Yeah. Also, loans is not an income, it's an asset. The major source of income are interest on? Interest on loans. Then their major expense, their major operating expense is the interest on customers' deposits. What does that mean? Now, what gives rise to an income? It's an asset. So that means loans for banks, it's an asset. Bank for the loans, loan is an, for the bank, loan is an asset. Then customer deposit gives rise to an expense. That means it's a liability. So that means the customer deposits, it's a liability. So account for bank. Once you know that that's what their major operating income or the major operating expense, that's all. Because the major aim of IAS that is to provide on how to account for banks. How do banks prepare financial statement? Who regulates the banks in Kenya? Yeah, central bank. Yeah. Then what's the accounting for banks? For accounting for banks being governed by, number one, we have the accounting standards. Regulated is by central bank. Accounting standards. Also, it's also guided by the Companies Act. Companies Act. Also, there is Banking Act. Banking Act. But in this case, our major concern on how do banks prepare the financial statement, that's accounting for the banks. So you see that for the banks, their major operating income are the interest on loans, and then their major operating expense are the interest on customer deposit. How do the bank prepare their financial statement? So how do they prepare the income statement? Now to the income statement. So under the income, they factor in all the interest income, be it the interest on loans and advances, interest on placement with other banks, interest investment in government security, interest on finances, all that. Then you deduct the interest expense. Yeah, be it the interest expense on customer deposits, on deposits from other banks, other interest expenses, all that. Once you take the interest income minus interest expense, that's how they get their net interest. Now, once you get the net interest, now you can factor in other operating and non-operating incomes. So we add other incomes, such as dividend income, investment income, foreign exchange income, commission income, all that. Then once you add all the other incomes, you deduct other expenses. That other expenses, such as admin expenses, all that. Depreciation, and that's how they determine their profit. So take the interest income, you less interest expense to get the net interest. Then you add in other income, then you deduct other expenses. Then how do they prepare the statement of financial position? Statement of financial position. Now, when preparing a statement of financial position, the format is the same for all the organization. We'll start with the non-current assets. You take the current assets, you take the equity and the liability. It's only for the bank, their statement of financial position is different from other entities. they're saying that all the statement of financial position are the same. Non-current assets, current assets, apart from for the banks. How do the banks prepare their financial statement of financial position? Now, for the assets, they don't recognize them into the major class, that non-current asset and current asset. Rather, they arrange the assets in the order of their liquidity, starting with the most liquid asset. That means the first asset to be recognized with the cash and cash equivalents. Also, deposit with the central bank. Also, we have investment in government security. Also, we have deposits due from other banks. Also, deferred tax assets. Also, loans and advances to customers. Also, we have PPE, that's plant property and equipment. And then the least liquid items are the intangible assets. Intangible. And that's how you get the total assets. Yeah, so you arrange the assets in the order of the liquidity, starting with the most liquid asset. Then you go to the equity and liability. Now, for the equity and liability, nothing changes. Equity and liabilities. For the equity and reserve, we have ordinary share capital. Also the share premium. Also, we have the statutory reserves. Banks are required to make some statutory reserve with the central bank. So we have the statutory reserves. Also, we have other reserves such as profit, that's retained earnings. Then we have the non-current liability. For the non-current liability, we have deferred tax. Deferred tax liability. Also, customer deposits. Yeah, we say that customer deposits are liability to the bank. Also, we have deposit due to other banks. Deposit due to other banks. Then we have the current liability. The current liability, we have the current tax and other liabilities. Good. So that's how the bank prepare their financial statement. So you can have a look for that for 1 minute before we do an session. In case you have a question, you can ask. Now that one should be Forex commission received. We're doing the illustration from the handout. I already shared the handout with you, the notes. So I'm saying that should be Forex commission received, not receivable. We have other operating income, fees and other expenses, impairment of loans and advances, admin cost, general operating expenses. We have income tax expense. We have retained earnings, deposit with the central bank, deposit due from other banks, government bond and other securities. We have loan and receive and advances to customer, other assets, deferred tax assets. We have other investments, deferred tax liabilities, other liabilities, current tax liability, deposit from other banks. Then we have the customer deposits. Additional information. Intangible assets were impaired by 20% as at the end of the year. Property, plant, and equipment is to be revalued to 12,750. An allowance for unserviced loan is to be created at 2% of the outstanding loan and advances to customer. Required. One is the income statement for the year ended that 1st of December 2017, and then the statement of financial position. So now let's start with the income statement. So how do they prepare their income statement? So this is Maendeleo Commercial Bank. For the year ended. So that we start with the interest income. So for the interest income, we had interest income on number one, loan advances to customer. We also had on finance risk. We also have on deposit with other banks. And then we have on government bonds. So here you had an amount of 15,042. $14,040. Then we have that 24. We have 72. That. Then we deduct interest expenses. Interest expenses on. Number one, we had on customer deposits. Then we had on deposit with other banks. We have an amount of 7,500. Then we had 168. And that's how we get the interest income. I mean the net interest income. Now, can you take the interest income, you rest the expenses? That one? 660. 668. 668. That's our net interest income. Then we can factor in other incomes. So for other incomes, we have fees and commission received. Fees and commission received an amount of 5592. Then we have forex commission receivable. We see that that one should be forex commission received, not receivable. Forex commission received an amount of 330. Then also we had other operating income. For the other operating income, we had an amount of 4,500. Then I think we have factored all the incomes. Then you raise other expenses. For the other expenses, we had fees and other expenses. We have an amount of 450. Also, we had impairment of loan and advances. We had an amount of 2520. We have admin cost. We have an amount of 11,580. Also, we had general operating expenses. An amount of 9420. Stop disturbing Valentine. Then we have income tax expense. So that one is not an expense. So the income tax expense, that's the tax for the year. I think we are done with all the expenses. Now let's go to the additional information. Intangible assets were impaired by 20% as at the end of the year. So we have impairment of intangibles. Impairment of intangible. You take 20% of the value of intangible assets. That's 6450. 645 times 2, you get 1290. Then number 3, let's go to additional information number 3. Number 3, we are told that an allowance for unserviced loan is to be created at 2% of the outstanding loan and advances to customer. An allowance for unserviced loan. That's what we call the provision for doubtful debt. So allowance for unserviced loan. So it's 2% of the loans. How much was the loans and advances to customer? We have 396,810. Give me that. $79.2, and that's how you get the profit before tax. So now let's take net interest income. You add other income, you less expenses. Sorry? 88, 93.8. Now we can deduct the tax expense. So in the trial balance, we're given the income tax expenses was an amount of 63. And that's how we get the profit after tax. So how much was the profit after tax? 25? 93.8. So that was the profit for the year. Now let's present the statement of financial position. So you say that for the bank, for the assets, you arrange them in the order of their liquidity, starting with the most liquid asset. Now, based on the information provided, who is the most liquid asset? Cash. But I can't see any cash there. So you have the deposits with central bank. Amount of that 8,400. Then we have deposit due from other bank. Amount of 57,600. Then we have government bonds and other security. Amount of 46 to that. Loans and advances to customers. Have an amount of 396, 810. But there was a provision for unserviced loan of 2%. The amount which was 79, 36.2. Okay. 388, 870, 873.8. Good. Then we have other assets. For the other assets, we have an amount of 2145. Then we have deferred tax asset. So that 180. We have 180. Then we have other investment. Investment is an asset. Other investment. Amount of 468. Then the first item we have in the trial balance, PP. PP is an asset, right? Yeah, we have PP, an amount of 12,750. Then we have, is that 12,750? Then we have intangible assets. Intangible assets is an amount of, that's 6450. But there was impairment of intangibles at 20%. You minus 1290. Do you get an amount of 50? 51? 5160. I think we have all the assets. Now let's add the total. Give me the total assets. How much is the total assets? Get 5, 541, 806, 5, 551, 860 point, 806.8. Now I go to equity and liabilities. For the equity and liabilities, we had ordinary share capital. For the ordinary share capital, we have an amount of 15,255. Then there is share premium. Share premium was an amount of, we have 270. Then we have revaluation reserve. Revaluation reserve. An amount of 7380. Eh? That's 7380. That is 7380. Eh? Then we have 1380. The teacher is always right. It's 1380, right? Let's go to note number 2. Note number 2. Note number 2, I told that property, plant, and equipment is to be revalued to 12,750. Now let's go to the 12 balance, the first item. How much was PP? Then was revalued to 12,750. A revaluation gained by how much? That's why I had to recognize this one as 12,750, not 6750. So it's 12,750. You raise the carrying amount. This is a fair value. The carrying amount was 6750. And there was a revaluation gain of 6,000. Then you add 1380, you get 7380. Then you also had statutory reserves. Statutory reserves. So statutory reserve was an amount of 5730. Then there is something missing there. What is missing under the equity? Retained profit. How much was the retained profit? A retained profit was 49. Are you there? Then you had the profit for the year, which was an amount of 2593.8. You get an amount of 50? 52? Yes? 531.8. 513. Then we go to the non-current liability. What can you see to the non-current liabilities? We have deferred tax, good. Other liabilities is a short term, other. Number one, we have deferred tax. How much is deferred tax? 4330. Then we also have customer deposits. Customer deposits, which is an amount of 452,985. Then can you see the deposit from other banks? Deposit from other banks. Amount of 6,600. Then we have the current liabilities. So the current liability, we have the current tax liability. Yeah, that's the tax payable in the next one financial year. Current tax liability, an amount of 3435. Then we have other liabilities. Other liabilities was an amount of 4338. Was that 300? Eh? Good. All right, add the total. We get? $551,806.8. Good. So that's how they present their financial statement. So in your handout, you have also provided another illustration, so you can go through that. If possible, you do it as an assignment. Then once you are done, you can mark for yourself. I've already provided the solution there, the question and the answer. So you can take a small break. Then we discuss accounting for insurance company. That's under IAS 14. Accounting for insurance. What are insurance companies? What are insurance companies? They are a company which does what? Okay, what are their major sources of income? And what are their major expenses? So their major income are what? Yeah, they are premiums. And then their major expense are the? Yeah, claims. They are those companies that covers risk at a consideration known as the premium. So they act under the principle of pooling of risk, of which they correct premiums, and then in case of any risk, they pay through claims. That's how the insurance company operates. Who regulates insurance companies in Kenya? IRI, right? Yeah, IRA, yeah. And we have two types of insurance business. Now, can you listen here? We have those who are busy reading what is the handout. The notes are yours. Kindly listen to what I'm explaining here. They won't read everything that's there. Then after 2 minutes, you ask them. They don't remember anything. Kindly just listen here. Number one, we have the general insurance. And then we have life assurance. General insurance, they cover against loss of what? Against loss of property. Life assurance covers against the loss of life. Not just necessarily life, because for the life assurance, they are classified into two. We have what we call the whole life policy. Now, this one is purely covers against the loss of life. So that means the in this case, the policy holder will not be the beneficiary. The beneficiary will be the next of kin. And then we have what we call endowment. Endowment policy. Yeah, all the medical cover, education policy, they fall under that, where the amount payable will be paid, the amount insured will be paid on the area of either death or maturity period. That's the difference between the two. But for the general, they just cover against the loss of property. Give me various insurance policies, you know. There is no car. Motor vehicle, Motor vehicle insurance. We have fire. Is motor vehicle not part of property? We have burglary or theft. We have marine, all that. Good. So now let's look at some terminology. One, we have what we call insurance. Number two, we have commission ceded. We have commission accepted. And then number four, we have reserves for unearned premium, also known as the reserves for unexpired risk. So what are these? Now, reinsurance, this is where one insurance company takes insurance cover in another insurance company. That's what we call insurance. Where one insurance company transfers its risk to another insurance company. Then we have what we call the commission ceded. Now, commission ceded is an income or it's commission received from other insurance company. Commission accepted, it's an expense. In short, is now, in this case, is the commission paid to other insurance company. Commission ceded is the commission received from other insurance company. Commission accepted is the commission paid to other company. So if the one receiving that becomes an income. And how do you determine the commission ceded? Now, we're saying that commission ceded, it's an income, which is determined as the proportion of reinsurance premium paid. Remember, you're saying that you are receiving or paying to another insurance company. So there is this reinsurance relationship. Then commission accepted, it's an expense. How do you determine this expense? It's determined as the proportion of the percentage of reinsurance premium received. Reinsurance premium received. And then we have reserves. What are reserves? What are reserves? It's a? Yeah, that's what we call reserve. Money set aside to cater for the future emergencies, right? So in this case, reserve for an expired premium or reserve for an expired risk is the amount of premium set aside to cater for the payment of claims in the future. And reserve is part of the equity. I think that is the amount of premium set aside to cater for the payment of the claims in the future. So reinsurance, we say that this where one insurance company takes an insurance policy in another insurance company, or where one insurance company transfers risk to another insurance company. Then commission ceded, we are saying that it's an income, which is determined as the proportion of reinsurance premium paid. Then commission accepted, it's an expense. And how determine it? As a percentage of reinsurance premium received. And then we are saying reserve for an expired risk or reserve for an expired risk, it's part of the equity. Money set aside of the premium to cater for the future payment of claims. Good. So now let's go through what we have in our notes. That insurance company covers risk for their clients for a consideration known as the premium. They operate using the principle of pooling of risks. The premium collected are utilized to compensate the client who have suffered the loss. Their main source of income is the premium, or the major expense are the claims. Now, for the purposes of determining the gross profit or loss, now that mostly is prepared, because for insurance company also they prepare what we call the segment report. After all, we want to determine if this is an insurance company, between motor vehicle, fire, and theft department, which one made a lot of revenue? Which one made a lot of also profits? How do we evaluate this? We evaluate this by preparing what we call the revenue account. You compare the major income that are the premium against the claim. And there are two types of insurance. Yeah, can you add something? There are two types of insurance business, right? That two types of insurance business. Add the word business. Number one, we have the general insurance and we have the life assurance. For the general, you see that this covers against the loss of property, stroke assets. Then for the life assurance, this covers against the loss of life. And there are two types of life assurance policy. One, we have the whole life policy. Now, the amount secured is only payable after the death of the policy holder. After the death of the policy holder. So that means the policy holder will not be the beneficiary. Who will be the beneficiary? Next up. Next up. Now, cross-rep. Now, if you take an insurance policy for the whole life, who do you cover? Yourself. No, you no. You see, when you cover yourself, against death, you have to indicate who will receive the amount upon your death, right? Those are your beneficiaries. Who will you write? I'm reasoning. They're also reasoning, eh? You are... Sasa. Utaandika your next of kin. No, we are not talking about now. Actually, the life assurance hauchukuangi ukiwa kijana sana sana. Are you together? So it's when you have a family, together. Your wife and kid, You're ni uongo. What about Brayo? Your brother, You have your brother? Yeah. Actually, if you have a younger brother, actually that's what most people do, They found that their youngest brother has a share and they exclude their wife. They only given the house they are living, the matrimonial home, The rest goes to the siblings, children, and their younger brothers. Who will you cover? Let's be honest. Children. Now let's go to the ladies. Who will you cover? Who will you cover? Children. You not cover your husband. You will. 1%. When will you cover? Sorry? You know what? Who can you cover? Your children. Your brother. I don't mean you have children now, but later you have some children. You'll not be sure whether the children are yours. There is that provision. The only thing you are sure that your brother is your brother. For many years. Yeah, for them, they are sure. You also, for the children, they know that one thing they can be sure is that this is their mother, but they are not sure this is their father. Anyway, now that was whole life policy. Then we have endowment policy. Now, for endowment policy, this is where the sum insured is payable on the area of either death or a specific date, which is considered as maturity what? Date. Yeah, in this case, you take a cover. For example, mostly for they have education cover, also they have medical. Also, which other policy has a maturity date? Retirement. No, actually nowadays insurance, they don't accept old people, to be honest. There is some age. Once you reach a given age, they consider as a high risk. Yeah. Because you know what happens is the area of you take a policy of 20 years and then they assess you. For number one, you have to go for the medical test. That's what happens. What you can cover, another insurance company. Yeah, so sometimes they look at the age. There's some age limit you cannot take a life assurance cover, which is 65. Depends. Now we are talking about the whole life policy. Can you go and search on that from the insurance companies? Yeah. So for them, number one, they have to assess. That's why they have those who are done actuarial sciences. Someone who can look at you like this and tell you are worth. Okay. Yeah. Or how do you value someone? How do they quote? Sometimes they quote in monetary terms, right? Is that possible? In accounting, everything should be quoted in monetary terms. The sum insured, what, all that. Yeah. Using what we call the actuarial assumption. That's what they assess. So now let's look at some terminologies. Number one, we have commission ceded. Now, commission ceded, this is an income which is based on the percentage or the proportion of reinsurance premium paid. Can you underline that? Income based on the proportion of reinsurance premium paid. That one should be at your fingertips, not for decoration purposes. So, is the commission earned from other insurance companies? Then number two, we have commission accepted. That this is an expense which is based on the percentage of reinsurance premium received. Can you understand that? Yeah, it's an expense incurred as a result of other insurance company transferring the risk to the insurance company. Then you have reinsurance, and this is the transfer of risk from one insurance company to another, where consideration is the payment of the premium. Good. Or it's where one insurance company takes insurance cover in another insurance company. Then we have reserve for an expired risk or reserve for an earned reserve. No, can you cancel that reserve? The second reserve should be reserved for an earned premium. Reserve for an earned premium. We note number 4. You think that it's reserved for an expired risk, stroke reserve for an earned premium. Well, that's why aggregate you have your hard copy. Good. And this refers to the amount of premium set aside to cater for the payment of claims in the future. So I want us to take a small break, time for prayers. Then we come, we assess on how do we prepare the revenue account. So now I'm back. Now we see that for performance evaluation purposes, the insurance department will have to prepare the revenue account to determine their gross profit. Now how do we prepare the revenue account? So you compare the inflows and the outflows. How do you prepare this? Now, this is how you prepare the revenue account. You see that the major source of income are what? Premiums. So, incomes, are they debited or credited? Incomes, are they debited or credited? Credited. What about the assets? What about the liabilities? What about the expenses? Yeah, all the income are credited, right? Now, and you see that for the banks, their major source of income are what? Not for the bank, but for the insurance, their premium, right? So how do they determine the net premium? Now, to determine the net premium, they'll take the amount of premium received, the net premium received. Then you add premium balance carried down. Remember, premium is an income. It's an income you have earned, but you have not yet received. You add the balance carried down. Then you deduct premiums balance brought down. Now that was the opening balance. That means their premiums that related to the last financial year. Then you add reinsurance premium received. But in case you paid, it becomes an outflow. Erase reinsurance premium paid. And that's how you determine the net premium. That's their major operating income. Then you factor in other operating income. Between commission accepted and ceded, which one is an income? Good. You add other income such as commission, ceded. Then they have reserves for an expired risk. Now, an increase in reserve becomes an expense. A reduction in reserve becomes an income. So in this case, you'll be comparing the opening balance against the closing balance. So here you factor in the reserves for an earned premium. An earned premium balance brought down. Then we see that you debit all the expenses, and their major expense are the claims. So how do you determine the net claims? Determine the net claims, you take the claims paid, then you add what you have incurred but you have not yet paid by the end of the year. That's the claims balance carried down. Then you deduct any amount of claims balance brought down. You also deduct any amount of claims recovered on insurance. Recovered on reinsurance company. Then you add any expenses that related directed to the claims. So you add the claims expenses. And that's how you get the net claims. That's your major operating expense. Then you factor in other expenses, such as what? Commission accepted. Also the management expenses. If there was any legal expenses. Bad debt. All those specific expenses. Then here we had reserves balance brought down. You compare the opening balance against the closing balance. So here you have the reserves for an earned premium balance carried down. Now, if the incomes are more than the expenses, that means the balancing figure will be on the debit side. That means they operated at a what? At a profit. If the income are more than the expenses, they operate at a profit. But if the expenses are more than the income, they operate at a what? That's good. If the balancing figure is on the credit side, that means overalls. Good. That's how they prepare the revenue account. Any question before I do an illustration? So now let's do illustration 1 in our notes. The foreign trade balance was extracted from the books of Maripo Insurance Company Limited, which specializes in general insurance as at that 1st of March 2017. So there is freehold property, there is motor vehicle, machinery and equipment, furnitures, audit fees paid, director's fee. As you can see, the audit fees paid. That one is an expense, but that one does not affect the revenue account. Because if you're auditing, you audit the insurance company. You engage to audit an insurance company. That's what we call a general expense. Now, general expense does not affect the revenue account. General expense goes directly to the general income statement, not to the revenue account. Revenue account, you only adjust for the specific expenses. An expense that can be directly attributable to a given policy. Then we have director's fees, depreciation on current assets, management expenses. Now, for example, this one will affect the revenue account because they are specific. We have for marine, we have for the fire. We have account receivable and account payables. We have investment income. We have ordinary share capital. We have share premium. Retained profits premium outstanding as at 1st of April 2016. That's the premium balance brought down. We have an earned premium. Those are the reserves for an earned premium at the beginning of the year. And then we have claims outstanding as at 1st of April 2016. Those are the claims balance brought down. We have the claims paid, legal cost, expenses relating to claims, bad debt written off, investment in shares. We have direct premium received, reinsurance premium received, reinsurance premium paid, bank balance, and the cash in hand. Good. Added information. Number one, reserves for unexpired and earned premium reserves for an expired risk to be maintained at 100% and 50% for fire, for marine insurance and fire insurance respectively. Commission on both insurance ceded and reinsurance accepted is at the rate of 5% of the premium. The directors have proposed a dividend of 5% on the outstanding share capital as at that 1st of March 2017. There was a proposed dividend. Now, reason here. We used to account for proposed dividend. We used to account. Are you together? I don't know. New reporting standards. We don't show them in the financial statement. They only show them as a disclosure. In case we had a proposed dividend, we could have deducted from the retained profit. Then issue it as a liability, since we have not yet paid, but we have proposed. But nowadays, we don't provide it in the financial statement. It will only appear to the notes to the financial statement just as a disclosure. You only account for dividend once paid or when paid, not when proposed. I hope now that information is home. Good. So that means number 3, for us in this scenario, it's irrelevant. The tax rate applicable is 30%. Premium outstanding as at that 1st of March 2017. That's at the end of the year. Those are the premium balance carried down. Number 6, claims intimated and outstanding as at that 1st March 2017. Those are the claims outstanding at the end of the year. Those are the balance carried down. Required. Revenue account for both marine insurance and fire insurance. So how do you prepare that? Your account. And kindly don't compete with me when it comes to copying. Kindly don't compete with me. That's why I shared the notes in advance. Have the notes. If you copy, you won't understand anything. So we had marine and fire, marine and fire. So now let's go back to the trial balance. Yeah, format is very important. So you need to understand that format. So we have freehold property, that's an uncurrent asset. Motor vehicle, it's an uncurrent asset. Machinery, it's an uncurrent asset. Furniture, an uncurrent asset. Audit fees, general expense. Director's fee, general expense. Depreciation of non-current asset, general expense. Then we have management expenses. Now, management expenses will affect our revenue account so that you debit all the expenses. And here we have the management expenses. For marine, it was an amount of 780. And then for fire was an amount of 696. Then we have account receivable and account payable, investment income, ordinary share capital, share premium, retained profit. Then we have premium outstanding as at 1st of April 2016. That's at the beginning of the year. That's what we call the premium balance brought down. So that one will affect the premium. So that you raise premiums balance brought down. For marine, we had an amount of 1080 to eliminate. Also, we had 840 euros. There was an earned premium as at 1st of April 2016. That's what we call reserves for an earned premium balance brought down. You say that you credit the reserves for an earned premium balance brought down. For marine, we had an amount of 5760. And then the other one, we had an amount of 3,000. 3,000. Then we had claims outstanding at the beginning of the year. That's the claims balance brought down. Yeah, we see that you raise claims balance brought down. We have an amount of 29.64. Then for fire, we have an amount of 21.60. 21.60. 960. So claims outstanding was 960. And then we have 648. And then we have claims paid. Claims paid an amount of 29.64. Then we had an amount of 21.60. Legal cost, that's an expense, so that you debit all the expenses, such as legal expenses. So we had an amount of 216 and 156. Then we have expenses relating to claims, marine. That's a specific expense. Yeah, we say that for the claims, you add claims expenses. They are given expenses relating to claim, that's for marine, an amount of 384. You see that we add bad debt written off, that's an expense, so that you debit all the expenses. So we had bad debt. For the bad debt, we have 204. Then we had an amount of 144. Investment in share, that's an asset. Direct premium received, that's a premium received from the client, not from other insurance company. Premium received direct was an amount of 54. And then for fire, we had an amount of 4,200. Reinsurance premium received. If we received, that means it's an inflow. So that we add reinsurance premium received. So we received an amount of 1,440. And then we had an amount of 960. Reinsurance premium paid. If we paid, that's an outflow. You raise reinsurance premium paid. Marine, we paid an amount of 960, and fire, we paid an amount of 600. Good. Let's go to the additional information number 2. Additional information number 2. Commission on both insurance ceded and insurance accepted is at the rate of 5% of the premium. Yeah, both commission ceded is at the rate of 5%, as well as for commission accepted. You take 5% of the premium. So how much was the premium here? Hey, it's already here. 54. What about for fire? 42. There is something I told you to underline, and I said it's not for decoration purposes. Can you go back there? What's commission ceded? Aya, read for me. What's commission ceded? It's an income, which calculate on the based on the percentage or proportion of reinsurance premium paid. So it's 5% of the reinsurance premium paid. Here we paid 960, we paid 600. What about commission accepted? Is an expense determined how? Good. Received, give me received. Yeah, reinsurance claims received was an amount of 1,448. And I told you that those definitions, apart from knowing that it's an income or an expense, you need to determine how do we determine it. So know what's a commission ceded. It's an income determined as a proportion of the insurance premium received. Good. 5%. 96 divided by 2 get 48, right? 60 divided by 2 get 30. 144 divided by 2 get 72. Eh? Here you get 40. Number 5. Number 5. Premium outstanding as at that 1st of March 2017. When is that? That's at the end of the year, right? Yeah, those are the premiums balance carried down. You see that we add premiums balance carried down. So I told that premium outstanding as at that 1st of March 2017 amounted to 1,800 and 840 for marine insurance and fire insurance respectively. Number 6, claims intimated and outstanding as at that 1st of March 2017. What are those? Claims balance carried. Yeah, we say that to the claims you add claims balance carried down. For marine was an amount of 900. For fire was an amount of 576. Now, can you give me the net premium? Others to give me the net claims. Just want the net premium and the net claims. Fire, where? Uh-huh. 45, 60. 600 claims. That's true. 88, eh? Uh-huh. 2018. 2088. Good. Now let's go to additional information number 1. Additional information number 1. Number 1, you are told that an earned premium reserve for unexpired risk is to be maintained at 100% and 50% of the premium for marine insurance and fire insurance respectively. Those are the reserves balance carried down. And you are told that claims, an earned premium reserve for an expired risk is to be maintained 100% and 50%. So we already have the net premium. See that reserve for an expired risk is the amount of premium set aside to cater for the future payment of claims. For marine, the net premium we have is an amount of 66. They are to maintain 100%. So we have 66. Then for fire, we had an amount of 4560. We maintain 15. You get 20? 22? Now we determine whether they operated at a profit or. Now, can you add the total on the credit side? You just take the net premium, you add the income. That's 4567, 7590. 7590. Do for the claims. Marine is 48, eh? 480. Good. Here we have 12 480. Now give me the balancing figure. You take that, you minus from the net claims, all that, including the reserves. Sorry? No, you must be told. You know, every insurance company has their own policy. So you must be told how much to maintain. Where? 1240? 1248. That one? 2178. So assuming you are the MD, between the marine and fire policies, which one are performing better? Fire, Yeah. Number 2 of the question. Number 2. Statement of comprehensive income for the year ended that 1st of March 2017. I prepare the income statement. This is Maripo Insurance. prepare the income statement for the year ended 31st of March 2017. Now, this is a general income statement. So, shillings are in millions. So, we start with the revenue. For the revenue you have for marine and fire. So, you take the profits. For marine, we had 1248. Then for the fire, we had 2178. There was investment income. How much was the investment income? Investment income was an amount of 330. Then you deduct general expenses. Expenses which were not captured in the revenue account. So we have audit fees, of which we have an amount of 288. Then you also have a director's fees, an amount of 594. Then there was depreciation of non-current assets. Depreciation was an amount of 1086. Give me the profit before tax. You're getting an amount of 78? Good. Then you raise tax. Let's go to note number 4. The tax rate applicable is 30%. So you take 30% of 1794. 538. Give me the profit after tax. 0.8, 1255.8. Lastly, number 3. We prepare the statement of financial position. So I won't wrap the income statement. You have a question? Any question? Lucy, do you have a question? You must be having a question. Ask. Ida asked the question. Or you're trying to explain to her? 1248. I explained to her. Even for you, you are lost. Where did that 1248 came from, by the way? It was balancing fee. But I saw you calculating. What were you calculating? You adding the total. And then it balanced all of a sudden. 1248, 1248. But you didn't know that 1248 was a balancing figure. That was the balancing figure. The income minus the expenses. So now let's present the statement of financial position. We need, how much is the tax? 538.2. Are you together? Valentine. These were profit, 1255.8. Because we need them. Now let's start with the non-current assets. We have the freehold property. Amount of safety 40. Have the motor vehicle. Motor vehicle is an amount of 4,200. Then we have machinery and equipment. Amount of 1,800. Then we had furnitures. An amount of 1,560. Then we had investment in shares. Yeah, that's a financial instrument. Yeah, that's available for sale. Can you see that? How much was the investment in shares? So investment in shares was an amount of 16,800. I hope you have seen it. Go to the current assets. What do you have to the current assets? Yeah, bank and cash balance. An amount of 132. Then we had account receivable and account payable. So how much is account receivable? Account receivables was an amount of 870. Then we go to equity and liabilities. What do you have to the equity and liabilities? Good. Ordinary share capital, an amount of 36. What else do we have? We have share premium. Share premium is an amount of 1,200. Then we have retained profit. Yeah, retained profit is a reserve. So retained profit at the beginning of the year was an amount of 540. Then you add Valentine. How much is the amount? 1255.8. You get an amount of 1790. 1795.8. Then I didn't see any non-current liability. So what we have is the current liabilities. What can you see as a liability? Can you see account payables? Account payables was an amount of 390. Do you have any other liability? Yes. Can we go back to note number 4? The tax rate applicable is 30%. We made a provision at 30%. You see, it was not captured in the trial balance. What does it mean? We have not paid. Are you together? Anything captured the trial balance, that means has already been adjusted. So in this case, we have to make a provision of 30. We accounted for it in the income statement, but we have not yet paid. So therefore becomes a current liability. So we had the current tax. Winning was how much? 538 point? Good. What's a reserve? We said it's the money set aside, right? Let's be here now. We are told that they were to make a reserve 100% and 50%, and reserve is part of the equity. So we have the equity, we have reserve for an expired risk, reserves for an earned premium, for marine an amount of 66, and then you add 22, 2280. That is 88.8, right? What are premiums? Okay, how do you account? Okay, what? Don't define what's a premium. What's a premium? It's an income, right? So if we have an income that we have not yet received by the end of the year, it becomes a what? It's not an accrual. It becomes a receivable. All together. We have earned, but we have not yet received. Let's go to note number what? Note number 5. Premiums outstanding as at 31st March 2017. Yeah, the premium balance carried down. That means we have already earned, but we have not yet received. So it becomes a receivable. So it's part of current asset. So we have the premiums receivable. So we had an amount of 1,800 and 840, and you get 26. What are claims? Expenses. So we have an expense we have not yet paid by the end of the year. Becomes a what? Payable. Good. Or accrual. Let's go to note number 6. Claims intimated and outstanding as at that 1st of March 2017. So those are the claims payables or accrued. So we had an amount of 900. Then we had 576. We get an amount of 1476. What is commission ceded? It's an income, right? But you see, it's not captured in the trial balance. We made a provision at 5%. We have accounted for an income we have not yet received at 5%. Commission ceded is an income, but we have to make a provision of 5%. That means you have not yet received. So it becomes part of what? Receivables. Good. Commission ceded. So 48 plus 30, you get 70. What's commission accepted? It's an expense. We have made a provision of 5%. That means we have not yet paid. If it was a trial balance, that means we could have already paid. So it will not affect the balance. In this case, we made a provision of 5%. So that means an expense we need to pay. So we have commission accepted. So we had an amount of 72 and 48. So that is 120, right? Have you confirmed? Yeah, 120. Now let's try to balance now. What about dividend? What is that? I spent 3 minutes to explain, and I remember saying that I think the point is home now. We say that proposed dividend will only be disclosed, will not be accounted for. Are you together? We only account for the dividend that you have already paid. Yes. Before you used to account for it. Yeah, we could have accounted for it. You deduct from the retained earnings, and then you show that you have not yet paid. Therefore, could have affected what? The liabilities. What do you get as the total assets? 18. And what about equity and liability? 18,006. Good. I've also provided another illustration. It's upon you whether to do it, not to do it. Of course, I'm sure you won't revise. You know what you're made to revise? That's what comes in your exam. Have you ever noticed that? You have never noticed, you just leave some things out. That's what will be tested. So I think now we can call it a day. Now, next class, kindly now I advise you. Now we are moving from one state to another state. Now you need to recognize that now you are in advance. So now you're going to serious business. Actually, they are very easy. They are very easy, but they are very vital now. Yeah, so kindly don't miss any of the classes. If possible, don't miss any of the classes. You only miss when I miss. Are you together? Yes. I'm not planning to miss any class soon. I love my work, so. Mnapenda masomo kweli? Masomo ni ngumu na ina wenyewe. Yeah, so that's why I'm saying that sacrifice now. Don't miss any class. Don't miss any class. Now you are going to serious business. The topics now we are remaining with comes with 20 marks, 20 marks, 20 marks. So you have 3 major topics waiting for you. Yes. Which are, hata nikiwaambia utasahau tu. You just get the remaining topics. Don't miss any class. No.